Hey, welcome everybody to the 40 Finance channel. Today we're going to be talking about video game stocks. I read this article you see up here today, and I didn't have enough time in the day to do a record and an edit, so I'm just going to run live with it on some quick thoughts about video game stocks, gaming stocks, and where that market is headed. Obviously, over the pandemic lockdown, video games and everything related to them went up substantially as folks had very few other alternatives for in-house entertainment. So I at one time owned a peripherals maker, Turtle Beach, that makes the headphones, third-party headphones that you see a lot of the gamers use. There's also stocks like Corsair that are pretty popular, I would say, at least last year. But now here we are, and the landscape has changed. We still have some backlog on PS5. You can't just go to a store and buy a PS5 yet, at least not here in Cincinnati. I happened to be at Best Buy this weekend, and I double-checked to see if any of those were in stock, and they're not. We do have a couple at our house that I was able to get through the holidays by waiting in the online queues like everybody else. But long story short, now that the boom is over, if you believe it's over, then these are stocks that are falling into similar story as other pandemic plays where you're potentially facing declining revenues, declining earnings, etc. So I thought today we'd just do a quick look around at some of the big names. I do not own any of these names except for those that are in the NASDAQ QQQ, which I obviously talk about quite a bit, and big fan of QQQ. So let's take a look at Seeking Alpha. Good to see you, Lion. And let's just do a quick review of what this article says. It just came out today. Following what was in large part a rough month for video game stocks, the sector is seeing several new trends emerge that are likely to color investors' sentiment about the likes of EA and others. Wedbush Securities analyst Michael Pachter said Tuesday that booming inflation levels, along with ongoing concerns about the economy, has caused the overall market to decline precipitously in recent months. We already knew that. And that video game publishers weren't spared from the carnage with investors heading to the exits. All right, so that is kind of what has happened. I'm trying to look through here to see what does the future hold for several of these names that gets listed. There are few catalysts over the near term to restore investor confidence in the game publishers, and it will likely require a rebound in earnings to trigger a rebound in share prices. So again, if this is true, which this is an opinion of the author, then, if you're looking for rebounding earnings, or let's just say positive comps, which we'll get into here in a second, it could be a rough year, right? Because the comp from last year in 2020 is going to be so high for many, many of these companies. Pachter said that there are a handful of themes that are emerging that are going to play notable roles in companies' growth prospects. One of those is in-app advertising. It is becoming increasingly important for app developers to monetize their games through the deployment of ads. Pachter also said that subscription offerings, such as recent new options from Microsoft and Sony, are providing new and compelling outlets for incremental revenue increases. Pachter also said that more games being developed for the cloud, which requires providers to need less hardware, should significantly expand the industry. So what I'm getting out of this, just on those quick blurbs from the article, is this year could be rocky because of the comp issue I was talking about, but there's several trends emerging that look very healthy for the industry. So that's, for such a negative headlines, prepare for more rough times ahead, I would say that there's not a ton in here that suggests, that things are going to be awful. Now, I did find a article from a few weeks ago. Video game sales sink 19% in May, 27-month low. I think it's self-explanatory in the headline. May's overall sales tumbled 19% to $3.68 billion from a year ago. So we're down about 20%, at least in the month of May, on video game purchases. That's the lowest total since February 2020. Ironically, right, that is, arguably prior to the start of the pandemic. April sales had fallen 8%, providing a brief turnaround in the decline curve. December sales had shown up, down 1% from the year prior. January dipped 2%. So with that in mind, we see this is a negative trend. So down 1% in December, January 2%, February 6%, March 15%. Now, April was a relatively positive month in terms of comps because it only fell 8%. But now here we are in May, going down, upwards to 20%. So we're definitely seeing the pullback in the overall sales numbers. But some of that isn't as important as the projections for the future and where we think things are going to land, right? So you could make the argument before we look at the future that this bad news of negative comps, it offers an opportunity if you think things are going to bounce back. Let's see if we have any information. Year-to-date spending is now down 14% versus the same period. For the month of May, PS4, and that's an accessory there, the controller. In-game content, only one new game appeared in the top 50, so that's huge. Rounding out the dollar sales chart, we had MLB The Show, blah, blah, blah. Mobile games are still growing, though, at a linear rate, led again by a significant drop in spending through Google Play, while App Store gaming spend is about 2.6% off in May. So to translate that very quickly, it's obviously showing that mobile games, as opposed to traditional video games, are not down quite as bad. But when I think about some of these numbers, particularly this one here, only one new game appeared in the top 50 on the sales chart. This is one of the things that you're going to see in video games, and it's not much different than what you see in other sectors of the stock market. And that is, new releases power a lot of things, right? So while we are down this year, all it takes is a handful of promising titles come out, say in fall, right? And you can resurrect a whole year's worth just by getting people out to purchase the new copies. And with that, we're going to go to a positive article. Truist, which is another analyst firm, bullish on video games, but cuts Roblox to hold. All right, this is June 17th. Let's see if we can just skip to the meat of this. We continue to expect the interactive end market to be relatively resilient in a recession, small ticket consumer as opposed to big ticket consumer, though not immune. He's got, let me tell you who he is very quickly. It's analyst Matthew Thornton. He's got buy ratings on most video game names, but Truist has downgraded Roblox to hold, saying it screens least favorably of the group. Okay? May metrics were weak again, he noted. He's cut the price target from Roblox to 29 from 36. On the opposite end from Roblox is what he called the most positive standout quarter today, Take-Two. Twitch trends, search interest, and mobile in-app purchases look relatively positive, driven by NBA 2K. And Grand Theft Auto is tracking down largely as expected. Truist price target is 175, which implies 39% upside. Thornton has buy ratings on EA, SCPL, and Activision's Blizzard, Oh, as for Activision Blizzard, it got a hold rating, but eyes a strong start for Diablo Immortal, as well as looking ahead to Overwatch 2 coming in October in Diablo in 2023. So that's really what I was looking for there, is a little bit of bites, sound bites on which video games are actually coming out. Looks like this Overwatch 2 could be a popular pick. But let's stack up all of these stocks together, and we'll use Seeking Alpha, of course. Obviously, if you are new to the channel, I use this all the time, and my affiliate link's in the description if you're interested in a free trial and a discount. But what we have here is EA, Microsoft, Take-Two, Activision Blizzard, Sea Limited, and Unity. So of these, Microsoft and Sea Limited, you could argue, significant exposure to games, but those are also companies that do other things as well. Kevin Hawthorne, good to see you. And let's go down the list. I'm going to skip ahead to the future, right? As I often do on this channel, we're going to get past the fundamentals, and we're going to look at what could happen in the beginning. So first of all, what has happened here in the recent past, if we just go year to date, minus 6%. And if we look at the 1 year return, it's minus 13%. So that's EA. Year to date, minus 6. Microsoft, minus 22. Year to date, minus 4% on the year. Take-Two, minus 30, minus 30. Activision, minus 18, minus 15. Sea Limited, which is not a profitable company at this point, minus 70% and minus 75%. And then Unity Software right there in the midst of it. Now let's see who's growing what, at least from a consensus standpoint. So just to be fair to everyone on the board, since I haven't studied all of their balance sheets, I'll use non-GAAP earnings because that is, at least for younger companies, relatively more common. Non-GAAP trailing 12 months, you got EA at 17, Microsoft at 28, Take-Two at 24, Activision 24. Now, if we say non-GAAP looking forward, let's see if we have that. Where is our non-GAAP looking forward? They actually don't have it on here. We got a PEG ratio. Well, let's just do our PE gap forward then. You're looking at EA at 36 times, Microsoft 26 times, Take-Two 30, and Activision at 30 on a gap level. Sea Limited and Unity, obviously not fully profitable yet, so they have nothing. So at the 30Xs, looking ahead forward, there's not a huge, I wouldn't argue that there's huge deals here, particularly when you have the Facebooks, Googles, etc., who also play in gaming to some degree. They're down into the teens and 20s. Price to sales on these right now, 5X, 10X, 4X, 7X for ATVI, Sea Limited 3.31, Unity at 9X. So the Unity at 9X is probably pushing the envelope pretty hard. This is trailing 12 months, so but that's still pushing the envelope. Same with Microsoft. Now, let's try to incorporate some of this into growth, right? So these are growth projections. These have not been written on the board yet, but it's consensus growth projections, revenue growth, and then revenue growth forward. EA, 24% last year, basically gets cut in half to 12% this year. Microsoft, same thing, and this is across the whole Microsoft company, 20%, drop into 16 or so. Take-Two, they only grew 4% last year, but this year, 32% projected as of right now. Activision, minus 3% last year, maybe plus 3 this year. And then here's where you see what happened to Unity and Sea. Last year, they had great revenue growth, triple digits, in fact, for Sea Limited and Unity at 42, but both are dropping. Now, those are still strong growth rates, right? So C at plus 58% and Unity at plus 32, that's still, you know, probably some of the highest numbers you'll see in the stock market, but it's obviously pulled off significantly from the year before. What about our EPS growth, which is going to affect our PE ratios, right, going forward? EA last year actually negative comped earnings. Then you had plus 12, or you have plus 12 projected for this year. So that's a good sign. Microsoft plus 30% last year, still getting into the 20s, plus 22 if they hit their numbers. Take-Two down miserably last year on EPS growth, minus 30%. They nudge into positive territory. ATVI approximately flat, and then obviously nothing over here for these guys. So what does it all mean, right? And if we look, we go down here and we want to see how things are trending. So all of those revenue numbers, all those EPS numbers, which direction are they going? Well, if you look at the EPS quarter revisions, which is all the analysts coming in, and we try to figure out who's still up. Like, you know, of those numbers that are represented today, which ones have been going up here lately? Not much out of EA, 0 upward projections, 15 down. So that's obviously momentum in the wrong direction. Microsoft 17 up, 15 down. Call that a flip of a coin. Take-Two, 3 coming down. Activision, 22 coming down versus 0 going up. C, still positive with 3 ups and 2 downs. And then Unity gets a 0 on revisions upward, but 12 coming down. The story looks about the same on revenue. In fact, across all of the companies, if you take out Microsoft, you only have 5 upward revisions. And Microsoft has more downward revisions on revenue than upward. So it's very, the momentum is negative. You know, that doesn't mean that these can't pay off in the long term, but the momentum is definitely negative right now for video game stocks. If I were to pick one that I'm interested out of all these, if I had to purchase one, you know, it's hard for me to avoid Microsoft because if it's right into the kinds of things I'm looking for, particularly in this environment that we're in right now. But if I wanted to go with the best growth name, I think you do have to start to look at Take-Two and dig more into, let me see if I can bring this up here. We need to dig more into this potential, which is 32% growth on the revenue line, and try to dig in and see what could that be, right? Is that a new launch that's coming out? You know, we mentioned a couple games there, and how big can that be and how anticipated is it? The downside of playing a product launch, of course, is that the product fails miserably. But that's where my brain goes. That's sort of the state of the big dogs in the video game industry right now. You know, curious if you guys are into any of these. I would be, you know, I'd be cautious till you saw some positive momentum. But, you know, over the long term, I think video games win. It's just where things stand right now. The negative pressure on these stocks to grow revenue is really hurting their performance. And I'm not sure that if we had a total market rebound that they would be pulled up with that. I think Microsoft would. As far as C Limited, you know, I was mildly enamored with them going into, or, you know, listening to people talk about them so much. I can tell you that I haven't read about C Limited in a while, but one of the things that is concerning is how much their video game arm funds the rest of their operations. So, I would have to do a more of a deep dive on C Limited to see when are the other units becoming profitable, because that's a big thing with them. All right. We've got Lion saying the market has turned green. I'm over here. Of course, I really only care about the NASDAQ. But we do have some green. Here's the last 5 days. We're up over 11,200, which is not bad. Still trending close to the 52-week bottom. But that is a good news, because earlier today, things were not so good. I think the NASDAQ opened up minus, I want to say like 2% off the top of my head. Let me take a look over here at Yahoo, see what other headlines we have. Yeah, so here's your NASDAQ from the Yahoo view. And it's not showing negative. We must be on 5 day. There we go. So this is Friday where we closed. And then here's how things opened on Tuesday, and it's been going up ever since. This is a weird setup right here. NASDAQ 1.13% up right now. Meanwhile, S&P down almost 0.5%. Dow down 1%. You got crude oil under 100. Wow, I just now noticed that. Let me see. How many times have we hit under 100? Last under 100 was May 10, at least according to this chart. Had several in April. So that's interesting on oil. I don't know if there was a news release in there that explains, what's happening in that world. But this is a pretty decent, downward call, 8.3%. You figure prior to 4th of July, we were at 108. So you're getting almost $10 off on that one. But NASDAQ, I would say right now, is the most surprising. Definitely. Check it in on CNBC. Let's see what negatives they have going on. Second half is not looking good. Strategists on how to weather the storm. Euro slides to 20-year low against dollar amid recession worries. So that's versus dollar. That's not 20-year low, period. So, yeah, you've still got a healthy supply of negative nannies on here. Here's the market movers. Etsy, plus 9.5%. Caesars, plus 9%. Norwegian Cruise Lines, that's interesting as well. I did notice travel stocks in general were up across the board today. I don't see if, let me try to think of some American Airlines maybe. Because you got oil down on the airlines, and I saw the rest of travel stocks were up. So American Airlines 3.81%. I do not own this one. I was just sort of calling it out. Other people have Carnival plus 5%, so that's good. There's some bad rumors and vultures swirling around Carnival because of their debt levels. I think that they just had a very negative sentiment. Here we go. It was Morgan Stanley. So Jamie Rollo from Morgan Stanley reduced his EBITDA forecast to negative $900 million from positive $900 million, which would mark a third straight year of losses for the cruise line operator. Fiscal year EBITDA forecast was reduced to $5 billion on the expectation for weaker pricing occupancies. So he says that forecast dropped as we factor in occupancy pressure from continuing health protocols, as well as weaker pricing. Our EPS forecast come down more due to higher financing costs, with a 63% increase in fiscal year 22 losses. Not a lot of good news coming from there. And what's interesting is I recently did a video where I talked about Carnival and a batch of other stocks that were in similar positions. The big selling point, in my opinion, was that 2023/2024 is Carnival getting back to a positive EPS. You know, it'd probably be a while till their dividend comes back, but they've got some debt to work off. They've got some debt to work off, and if they can't get back to positive operations a little bit sooner, then, you know, it's not good news. It's just going to delay how far the stock can bounce back, quite honestly. Looking down here at their capital structure on Seeking Alpha, so you got debt of 36 billion, cash of 7 billion, market cap of 10, enterprise value of 39 billion. So, you know, this is definitely an elephant in the room, and we all know why this is here. $36 billion worth of debt, and I can't, you know, I don't blame the corporation for being in this hole, but, you know, the longer that you're running an unprofitable company with $36 billion in debt, I mean, you got to try to work this down because obviously interest rates are going up. We'll see how Carnival does. And you know, there's an easy cure for it, and that is consumer travel trends, which I still think are very good. But we'll have to see if that lasts into winter. All right, guys, hope you are doing well. I wanted to come in and do that video game video real quick. It was on my list today. Just share you some of the things that I'm seeing, and I'll get back to a more recorded format video here maybe tomorrow or the next day. So hope everybody had a good holiday weekend. Shout out to our friends, of course, in Chicago who are suffering through the tragedy. We are all pulling for you, and we are all on your side. So hope you guys are doing well. We'll see you on the next video.